In the next few sessions, we will talk about trends, support and resistances, and the market psychology behind these formations. We will also take an example of dollar-yen to demonstrate these concepts. Identifying trends is very essential for traders to form a view of the currency pair in order to anticipate the market. Since we would generally want to trade in the direction of the trend rather than on the opposite side, we need to understand what a trend is in order to identify it. A trend is the direction in which prices form peaks or troughs. If the peaks are making higher highs, then the trend is bullish. If the troughs are making lower lows, then the trend is bearish. If the market is going nowhere, it is said to be trending sideways. Therefore, a trend has three directions: up, down, and sideways, or bullish, bearish, and drifting. Now, there are three steps to identifying trends that we must constantly practice for any currency pair. A first step to identifying a trend, we should identify the primary trend. This is the long-term trend. If we see the 10-year, 5-year, 3-year, 1-year graph of dollar-yen, we can get a lot of information from this graph. We can see long-term trends, corrections, reversals, supports, resistances, etc. So the first step would be to identify what the primary trend is. The second step would be to identify the secondary trend or the intermediate trend. The time frame for this trend would be anywhere between 3 weeks to a month within the primary trend. Now, the secondary trend may not conform with the primary trend. There could be a correction in the primary trend, so the secondary trend might be in the opposite direction of the primary trend, or the secondary trend could just be a sideways movement. The market could be drifting, maybe waiting for a FOMC meeting or some economic indicators to show the market some direction. The third step would be to identify the near-term trend. This would typically be roughly 2 to 3 weeks in duration. Once we identify these three trends, it would be wise to trade with the trend rather than trading against it. As the saying goes, the trend is your friend. If you are a short-term trader and the primary trend is up, the secondary trend is downwards, and the short-term trend is bearish, but very close to a long-term support, you could go long, hoping to make some money on the bounce from the support. Now let's take a look at the market psychology behind supports and resistances. In general, in an upward trend, prices don't simply move up vertically, as they are always met with some resistance from players who wish to sell. There are always players with opposing views who sell at every uptick. When the selling overcomes the buying, the prices move back down. Now, the price peak at which the uptrend reverses is called a resistance. This is where the selling overcomes the buying. Then the prices continue to fall till they reach a point where the buying starts again. Those players who've missed out on the initial move and are waiting on the sidelines to take long positions to participate in the up move will start buying at this stage. The trough where the prices stop falling and start moving back upwards is called the support. Here the buying overcomes the selling and the prices start moving back up. Those players who only invested 50% of their money in the initial move will also start buying on retracements, and those players who went short at the resistance may start looking to take profit at this level at the retracement. Now, in an uptrend, you will find the supports and resistances at new peaks. The reverse is true for a downtrend. Prices move down due to selling pressure. However, at lower levels, the prices stop falling due to some buying interest. And when the buying overcomes the selling, the prices reverse. The lowest point where the prices reversed, the trough, is called the support. This is the point where the buying pressure overcomes the selling pressure. Now, in a falling market, in a down market, the supports and resistances form new lows. So we can see that there are three types of players: the shorts, the longs, and the uncommitted. In an uptrend, the longs are the participants who are in the money. The shorts are out of the money and are either waiting for a reversal or possible retracements or dips to square their positions. The uncommitted are also waiting for these retracements to buy. Sometimes, if the buying is very strong, the price simply gaps and the participants do not get a chance to buy due to the strong rally. Now, either ways, if the price starts retracing back to 1/3 or 1/2 or 2/3, the shorts start to square. The longs may add on to their positions and the uncommitted initiate their positions. This starts forming support for the currency. A similar psychology works as resistance. The shorts add to their positions on retracements, on upticks. The longs are looking to exit and therefore look at selling on any uptick, and the uncommitted are looking to short and therefore will start selling on any uptick. The higher the activity and volumes at a given price level, the more important is that support and resistance level. Another interesting observation that you will come across is that supports become resistances and resistances become support. The more recent the trading activity, the stronger the support and resistances. Now, big figures and round numbers act as natural psychological supports and resistances, and we shall look at that when we see dollar-yen. And therefore, it's not wise to place any orders near these numbers. The market will definitely test these numbers, and they will try to take out the stops. Market makers know where the stops lie, since these stops are placed in their order books. So let's look at these concepts practically on the dollar-yen chart. And we should also see what are the good practices that traders need to perform regularly for identifying trends, identifying supports, resistances, and finding entry and exit levels for their trades.